Most people think a stock market crash is something that happens to rich people on Wall Street. Numbers falling on screens, traders yelling, headlines you scroll past while making coffee. But here's the uncomfortable truth. When markets crash, they don't stay in trading apps. They don't stay in Manhattan. They quietly move into rent prices, job offers, grocery bills, retirement plans, and the timing of your entire life. And by the time most people realize what's happening, the damage is already done. Right now, another major market crash doesn't feel hypothetical. Markets are volatile, debt levels are high, AI hype, housing pressure, geopolitical risk, aging populations, everything feels fragile. That's exactly why this matters now. History shows us something brutal and consistent. Every big crash was obvious in hindsight, and every time, regular people paid the highest price, often without ever owning a single share. If you want clear, story-driven explanations of how money, power, and systems work without the usual financial noise, that's what we do here on the Simple Economic Blueprint. If this breakdown helps you see the world more clearly, take a second to like the video and subscribe. It helps the channel grow and keeps these conversations going. Let's start with a dangerous misconception. The stock market is not the economy. You've heard that before. But it's also not irrelevant. It's more like a pressure system. Most days, it's invisible. When it shifts suddenly, it changes the weather for everyone. At its core, the stock market is a place where ownership is traded. Not just money, ownership. Tiny slices of companies that produce real things, employ real people, and borrow real money. Rising prices signal confidence. Sharp drops signal fear. And fear doesn't just sit on a chart. Fear changes behavior. When markets crash, investors panic, but so do companies. Executives watch their stock price collapse and their incentives flip overnight. Stock-based pay shrinks, credit gets more expensive, shareholders demand cuts. The fastest, cleanest cost to cut is labor. First, hiring freezes, then layoffs, then wage growth stalls, while prices often keep rising. That's how a crash that starts on a screen ends up at your kitchen table. To see how this plays out, we have to go back, not to memorize dates, but to watch patterns repeat. In 1929, the Great Depression is usually taught as a stock chart. Market down, banks fail, people lose everything. But the crash wasn't the disease, it was the fever. In the 1920s, ordinary Americans were pulled into the market through margin loans, borrow most of the money, enjoy all of the upside. Newspapers sold a new era, productivity up, technology booming. Sound familiar? Then prices cracked, margin calls hit. People sold at any price, forcing prices even lower. As markets collapsed, banks went with them. Deposits vanished, credit froze, businesses couldn't borrow, farms couldn't finance crops, factories shut down. Within a few years, 1 in 4 American workers was unemployed, not because they owned stocks, but because the financial system they relied on had seized up. Jump to 1987, Black Monday. The Dow fell over 22% in a single day. It was shocking, but the broader economy didn't collapse. The system had buffers. The Fed stepped in quickly. Banks were stronger, and households weren't drowning in debt. Contrast that with 2008. Millions of people who never traded a stock lost their jobs, their homes, and years of progress. The crash began in housing. Mortgages were packaged into complex securities and sold around the world. When housing prices stopped rising, the math broke. Banks stopped trusting each other. Lending froze. Construction halted. Retail collapsed. People who did everything right were suddenly unemployed in the worst job market in decades. And the stock market recovered faster than people did. Indices hit new highs, wages lagged, home ownership dropped, younger generations delayed milestones. Market recoveries are not people recoveries. Today, the same logic still hits everyday people in 4 big ways. First, jobs. In a crash, companies protect shareholders first. That's not pure greed, it's the incentive structure. Executives are paid to defend shareholder value. Payroll is flexible. Debt payments and dividends are not. So even profitable companies lay people off simply because uncertainty makes caution rational. Second, wages. If you keep your job, your leverage shrinks. When unemployment rises, raises disappear. Promotions slow. Job switching becomes risky. Crashes often mark the end of wage growth cycles, even long after markets have bounced back. Third, prices. Crashes don't always mean cheaper
I just feel
groceries.
so sad
Some
about
crashes arrive with
Here, take a
inflation.
tissue. It's
Supply
okay.
chains break.
Hey,
Currencies
no raises
weaken.
this year?
Companies
Seriously?
raise prices to protect
this is
margins.
unbelievable.
You can end up earning less and paying more. Fourth, retirement. Crashes change timelines. Older workers delay retiring, clogging career ladders. Younger workers struggle to move up. If you're close to retirement, a bad crash at the wrong time can permanently shrink your income, even if charts later recover. Housing is where crashes quietly rewrite lives. After 2008, foreclosures reshaped neighborhoods. Homeownership fell. Institutional investors stepped in, bought distressed properties cheap, and turned them more into rentals instead of selling them back to families.
This crash is stealing
A
my
crash
momentum.
didn't just
I can't
reset
afford
prices.
these delays.
It changed
Every
who
crash-
owns the roof over people's heads.
Underneath all of this are incentives. The market rewards short-term performance, quarterly earnings, guidance, beating expectations. The real economy needs long-term stability, skills, infrastructure, communities. In booms, that tension is hidden. In crashes, it explodes. Companies slash long-term investment to survive short-term
I can't believe we
shocks.
lost so much.
Governments move fast to save
Wait, look at the news.
systems,
It's really
not
different.
individuals. Asset owners recover first. Wage earners recover last. That's not a conspiracy. It's math. Crashes also leave scars you can't see on a chart. People become risk-averse. They save more, spend less, and delay life decisions. Growth slows long after the market is fine. The real cost of a crash isn't points lost on an index, it's years lost on a life plan. Today, markets are more connected than ever. Algorithms trade faster than humans can blink. Debt is everywhere. Governments, companies, households. Central banks have fewer tools left. Households are already stretched. That doesn't mean a crash is guaranteed. It does mean that when something breaks, it spreads faster and hits deeper than most people expect. So what's the lesson? It's not don't invest. It's not panic. The lesson is awareness and resilience. Markets aren't casinos floating above real life. They're amplifiers. When they rise, benefits concentrate. When they fall, pain spreads. Everyday people don't need to predict crashes. They need buffers. Skills that travel between jobs, low fixed costs, emergency funds, and a clear view of how incentives really work. Because the most dangerous part of a crash isn't the day it happens, it's the quiet months after, when decisions made in fear become permanent. If markets recover but people don't, what exactly did we save? If this made you see market crashes differently, tell me in the comments how you think the next crash, whenever it comes, will hit everyday people the hardest. Share this with someone who still thinks crashes are just a rich people problem. And if you want more clear, honest breakdowns like this, you know where to find us. This is the Simple Economic Blueprint.